Stop what you're doing right now. It is Sunday night, April 4th, 2026, and the global financial market is about to reopen for the first time in 72 hours. And in those 72 hours, while silver was frozen, while the market was closed, while most investors were completely unaware, three separate events hit the financial system that have not been priced in yet. Not one, three. At the same time. The moment Globex opens tonight, all three get priced simultaneously. And if you are holding silver, or watching silver, or even just watching what is happening to this economy right now, you need to understand what is about to happen before it does. I have been modeling this setup since Thursday, close. What I am looking at right now is one of the most compressed repricing environments I have seen in years. And here is what makes it so critical. The short-term move and the long-term move point in completely opposite directions. Most investors are going to see what happens tonight and draw exactly the wrong conclusion. They are going to panic at the short-term signal and miss the long-term setup entirely. I am going to make sure you're not one of them. Let me start with the number everyone needs to understand first. Silver closed Thursday at $72.90 per ounce. That number is wrong, not because the data is inaccurate, because it is 72 hours old. It does not reflect anything that has happened since Thursday afternoon. It is a frozen price in a world that has kept moving. And when liquidity returns tonight, that gap between where silver is priced and where it should be priced gets closed all at once. That is not volatility, that is correction. That is the market doing what markets do, pricing in information the moment it can. Now here is the context you need before I walk you through the three forces. Silver did not enter this weekend from a position of strength, it entered exhausted. Back in January 2026, silver reached above $121 per ounce, parabolic, driven by monetary expansion expectations and the kind of speculative momentum that builds when everyone is positioned the same way. Since that peak, silver has retraced more than 39%. $121 down to $72.90. That is not a healthy consolidation. That is a structurally weak downtrend with relief rallies that keep fading. That is the foundation the three forces are hitting. And underneath that foundation, the entire precious metals trade has been running on one assumption for the past 18 months. One single belief that everything else depends on. The Federal Reserve is going to cut rates in 2026. That is the trade. Lower rates weaken the dollar. A weaker dollar lifts commodities. Silver goes up. It is clean. It is simple. And tens of billions of dollars of positioning have been built around it. Friday morning, that assumption got destroyed. The U.S. employment report dropped, and it was not what the market needed. 178,000 jobs added against expectations of around 140,000. Unemployment fell from 4.4% to 4.3%. Wage growth held firm. That is not a cooling labor market signaling the Fed can step back. That is a resilient labor market giving the Fed every reason to hold rates exactly where they are. And when the Fed holds rates high, the dollar strengthens. And when the dollar strengthens, silver comes under immediate pressure. Now here is the number that tells you how big this is. Before the jobs report, the probability of a rate cut by December 2026 sat at 76.3%. After the report, it dropped to 69.5%. The probability of a rate hike, which was sitting at 2% before the data, jumped to 10.5% in a single session. That is a five-fold increase in hike probability in one morning. And none of that has been priced into silver yet. The market was closed, the algorithms have not fired. The positioning is not adjusted. Tonight is when it all hits at once. That is force number one, a rate expectation shock that removes the core thesis supporting silver's recent price level and simultaneously strengthens the dollar. In a normal weekend, that alone would be enough to cause a significant gap down. But this weekend is not normal because force number one is actually the smallest of the three. Force number two is what turns a controlled move into something more dangerous. And to understand it, you need to look at what happened in the Gulf this week. Not because geopolitics is interesting, but because of the precise mechanical chain it creates inside commodity markets. The Strait of Hormuz is a 21-mile wide passage between Iran and the Arabian Peninsula. Approximately 20% of global oil supply moves through it. For the past month, that flow has been restricted by ongoing tensions. That alone was keeping energy markets tight. But this week, the situation moved beyond restriction into active disruption. Ceasefire negotiations between the United States and Iran collapsed. Iran refused diplomatic engagement entirely. Pakistan confirmed the full breakdown of mediation. And then missile and drone strikes hit Kuwaiti infrastructure, a refinery and a desalination facility, directly. This is no longer a contained standoff. It is spreading. Now watch what happened to oil prices, because this is the signal that connects directly to silver. Dated Brent crude, the actual physical spot price for immediate delivery, surged above $140 per barrel. Meanwhile, Brent futures closed Thursday just under $110. That is a $30 gap between physical oil and paper oil. In markets, that condition has a name: extreme backwardation. It means the market is so desperate for real barrels right now that buyers are paying a $30 premium over what futures contracts are priced at. That is not a normal market. That is a market signaling critical supply stress in the present tense. Now here is how that connects to silver, and why most people miss this entirely. When oil spikes like this, it does not just affect energy stocks. It triggers a chain reaction across the entire financial system. Oil spike creates inflation expectations. Inflation expectations push bond yields higher. Higher bond yields strengthen the dollar, and a stronger dollar creates immediate selling pressure across every commodity denominated in dollars, including silver. So now you have two completely independent forces: a jobs report and an oil shock, both arriving at the same time, both pushing the dollar higher, both creating downward pressure on silver's paper price. Either one of those individually would move the market. Both together, hitting simultaneously after a 72-hour pricing gap, creates the conditions for a violent reprice. But we are still not at the most dangerous force, because force number 3 is the one that turns a repricing event into a cascade. And this is the force that almost nobody is connecting to precious metals right now. The name is Blue Owl Capital. Remember it. Blue Owl is a $36 billion private credit manager. Not a fringe fund, not a startup, a core institutional participant sitting at the center of private credit markets. In the first quarter of 2026, investors in Blue Owl's funds requested redemptions equal to 21.9% of total fund assets. Nearly a quarter of all capital tried to exit at once. In their technology-focused fund, redemption requests reached 40.7%. Blue Owl capped withdrawals at 5%. Read that clearly. Investors asked for their money back. The fund said no. You can have 5 cents on the dollar. The rest stays locked. This is called gating. And if you know what gating means historically, your stomach just dropped. Because gating is one of the earliest visible warning signs of systemic liquidity stress. It means the underlying assets cannot be liquidated fast enough to meet redemption demand. It means the fund is holding things it cannot sell at current prices without collapsing those prices. So it locks the doors instead. Now here is why this matters for silver tonight. When investors cannot access their capital in one place, they do not just sit and wait. They need liquidity. They have obligations. They have margin requirements. They have other positions to manage. So they raise cash the only way they can, by selling what they can sell. Not what they want to sell, what they can sell. And what can they sell? Liquid assets, publicly traded equities, futures contracts, ETFs, silver included. This is the forced liquidation mechanism. The problem starts in one place: a gated private credit fund, and the liquidity response spreads it everywhere. This is the exact transmission chain that amplified the Silicon Valley bank crisis in 2023. The initial problem was contained. The liquidity response was not. Now hold all three of those forces in your mind at once. A rate shock that eliminates the core silver bull thesis and strengthens the dollar. An oil shock that accelerates inflation expectations, pushes yields higher, and further strengthens the dollar. And a liquidity shock that is forcing institutional players to sell liquid assets to cover exposure elsewhere. 3 independent forces, all pointing the same direction, all hitting a market that has been closed for 72 hours and has not priced any of them yet. That is the setup. But there is one more layer underneath all of this that defines how far this can actually go, and it is the number I want you to hold on to, because it is the most important data point in this entire video: the COMEX silver inventory. COMEX is the primary exchange where silver futures contracts are traded. Every futures contract represents 5,000 ounces of silver, and the entire system depends on there being enough physical silver in COMEX vaults to back those contracts if delivery is ever demanded. As of Thursday close, here is where things stand. Total silver inventory across COMEX, 327.96 million ounces. Registered inventory, the portion actually available for delivery against futures contracts, 76.42 million ounces. Total open interest on silver futures contracts, 114,379 contracts. Each contract is 5,000 ounces. Multiply that out, and total paper claims equal 571.9 million ounces against 76.42 million ounces of registered physical silver. That is a leverage ratio of 7.48 to 1. For every single ounce of silver that actually exists in a registered COMEX vault and is available for delivery, there are nearly 7.5 paper claims on that ounce, 7.5 entities who believe they have the right to that metal. Now here is why that number is accelerating. 1 year ago, total COMEX inventory sat at 531.87 million ounces. Today, it is 327.66 million. That is a 38% drawdown in 12 months. And in just the last 30 days, Inventory dropped by 21.5 million ounces, a 6.15% decline in a single month. The vaults are being drained, slowly, quietly, persistently. Here is the critical implication. When forced liquidation hits tonight and paper contracts get sold aggressively, that selling pushes the paper price of silver down, but it does not put a single ounce of physical silver into COMEX vaults. It does not change the 7.48 to 1 leverage ratio. It does not resolve the inventory drawdown. The paper price falls while the physical scarcity increases. Those two things move in opposite directions simultaneously. That divergence is not new. It has happened before. In 2008, and again in March 2020, paper silver was sold down aggressively during the initial liquidity panic. Physical premiums quietly expanded underneath. And then when central banks responded with liquidity expansion, the paper price did not gradually recover. It exploded. Because compressed paper prices sitting on top of genuine physical scarcity create the conditions for violent upside once the selling pressure exhausts itself. So here's what you now understand that most people watching silver tonight will not. Monday's move is not a signal about silver's long-term value. It is a mechanical event driven by three simultaneous liquidity forces hitting a frozen price point. The paper price and the physical reality are about to diverge. And the direction of that divergence, paper lower, physical tighter, is historically one of the most powerful setups this market produces. The question is not whether you should be watching. You absolutely should. The question is what you are watching for. And that is exactly what Part 2 covers. Here is exactly how this unfolds, step by step. Because in a setup this compressed, timing is not secondary information. Timing is everything. Sunday night, 6 p.m. Eastern. The CME Globex futures market opens. This is the moment all three forces get priced for the first time. The jobs data, the oil shock, the blue owl liquidity signal, everything that accumulated over 72 hours hits a live market simultaneously. Watch the opening print in silver relative to $72.90. That is your first data point, and it tells you immediately whether the market is absorbing this gradually or repricing all at once. If silver opens down $3 to $5, that is not noise. That is not random volatility. That is institutional algorithms recalibrating positions based on new macro inputs at the exact moment liquidity turns back on. A gap like that in the overnight session means the system is not processing this slowly. It is adjusting instantly. And in thin overnight liquidity, that kind of gap can extend significantly before buyers show up to slow it. Here is what thin overnight liquidity actually means in practice. During regular trading hours, there are hundreds of thousands of participants on both sides of every trade. Market makers, institutional buyers, retail investors, arbitrage desks. That depth absorbs price movement. But overnight on Globex, that depth disappears. The same selling pressure that would move silver $1 during the day can move it $3 overnight. This is not manipulation. It is simple mechanics. Less liquidity means bigger moves per dollar of selling. So the overnight session carries a real risk of exaggerated downside, not because the fundamental case for silver has changed, because the plumbing of the market at 2 a.m. is structurally different from the plumbing at 2 p.m. Then we move into Monday pre-market, roughly 8 callers to 9:30 a.m. Eastern. This is the window where the narrative management attempts typically appear. If there is going to be any official effort to slow the momentum, a headline about renewed diplomatic talks, a statement implying the Gulf situation is stabilizing, a Fed official suggesting more flexibility on rates, this is when it happens. This window has a history of being used to walk back overnight momentum before U.S. equity markets open. But here's the structural problem with that playbook right now. Markets have been conditioned by repeated failed ceasefire narratives over the past several months. Every rumored resolution collapsed. Every diplomatic hint turned into another escalation. Each time that happened, the subsequent selling when the story fell apart was worse than the selling it temporarily halted. The market has learned. The marginal impact of a reassuring headline is weaker today than it was 6 months ago. Credibility has been spent. That means even if a stabilizing headline appears in the pre-market window, it is unlikely to reverse the overnight direction. At best, it buys a few hours of consolidation before the primary move resumes. Then, 9:30 a.m. Eastern, the New York Stock Exchange opens. Full liquidity returns to the system. This is where the real move happens. Not the overnight gap, not the pre-market drift. This is where institutional size enters the market and direction gets confirmed or denied. And equities are not entering this session from a position of stability. The S&P 500 is trading below its 200-day moving average, a level that historically acts as the dividing line between bull and bear market structure. The Shiller PE ratio sits between 34 and 35, a valuation level that has been exceeded only once in modern market history, during the peak of the dot-com bubble. The Nasdaq is forming a rounding top, a technical pattern that signals distribution, meaning institutional players quietly reducing exposure over time before a larger move lower. This matters for silver because of a dynamic that almost always plays out in the first wave of a liquidity event. Under stress conditions, silver does not trade like gold. It does not trade like a safe haven. It trades like a risk asset. It trades like equities. Because the same investors who sell equities under stress also sell silver futures to raise cash. The correlations converge when liquidity is being pulled from the system. So Monday's initial move in silver is not primarily about whether silver is fundamentally cheap or expensive. It is about whether the broader system is experiencing a liquidity withdrawal event. And based on all three forces we have laid out, the probability of that is higher this Monday than it has been at any point in recent memory. Selling triggers more selling. Margin calls on equity positions force more asset sales. Portfolio managers, reducing risk across the board, sell futures contracts. Silver, being highly liquid and easily sold in large size, becomes a source of cash in a cash-hungry environment. This is mechanical, not fundamental. But mechanical moves are real moves. They affect real portfolios. This is the moment where most retail investors make the critical mistake. They see silver falling on Monday morning. They read the decline as confirmation that something is fundamentally wrong with the silver thesis. The monetary case is broken. The inflation hedge is not working. The bull market is over. And they sell into exactly the wrong point in the cycle. Do not be that investor. Now shift your attention to what happens after the first wave passes. Because this is where the information that actually matters starts to emerge. Monday through Wednesday is the COMEX window that matters most this week. Physical dynamics begin separating from paper dynamics during this period, and the signals that appear here will tell you whether this is a short-term shakeout or the beginning of something structurally larger. Watch inventory levels with precision. The annual low on COMEX silver inventory sits at 327.59 million ounces. Current inventory is 327.66 million ounces. That is a margin of 70,000 ounces between current levels and the lowest inventory reading of the year. In a market processing forced liquidation while simultaneously drawing down physical supply, that floor can be breached. If inventory breaks below 327.59 million ounces this week, it confirms that physical drawdown is continuing even under selling pressure conditions. That is not a bearish signal. That is a structural signal that the physical supply situation is tightening while paper prices are falling. Now watch dealer premiums in the physical market. This is the signal that separates noise from structure. If paper silver drops from $72 toward $64, toward $58, or toward $50, and the cost to acquire actual physical silver does not drop proportionally, that spread is telling you something that the futures market cannot tell you. It is telling you that real metal is not responding to paper selling, that the people who own physical silver and the dealers who supply it are not matching the paper market's panic. They are holding price. That divergence between paper and physical is the cleanest signal in this entire setup. It is the market whispering that the sell-off is mechanical, not fundamental, that the pressure is on paper contracts, not on the underlying asset. That divergence is exactly what appeared in March 2020 when paper, gold, and silver were sold aggressively to cover equity margin calls. Physical premiums expanded to record levels while paper prices fell. And then when the Federal Reserve announced unlimited quantitative easing, paper prices snapped back violently and then kept going for 18 months. Now let me bring this down to what it actually means depending on how you're positioned right now. Because the experience of Monday is completely different depending on your structure. If you hold physical silver, coins, bars, allocated accounts, nothing about Monday changes your actual position. Your ounce count does not decrease. The metal does not disappear. Your exposure to the long-term thesis, monetary debasement, debt dynamics, dollar weakness, does not change by a single dollar. What changes is the temporary fiat currency value assigned to that metal on a specific Monday morning under forced liquidation conditions. And if you understand the structure, that temporary decline is not a threat. It is information. It may even be an opportunity. The key price levels matter here, and you should know them before the market opens. The $64 to $66 range has acted as a significant support zone throughout the recent consolidation period. That is the first institutional reference point. Below that, the 200-day moving average sits around $58. That is the second reference point where large systematic funds are programmed to reassess positioning. Below that, the structural base near $50 represents the breakout level from the previous major cycle, the level that, if tested, would represent a complete round trip of the most recent leg up. Those are not random lines on a chart. Those are price levels where institutional behavior changes, where buyers who have been waiting on the sidelines start to deploy, where the selling pressure from forced liquidation meets genuine long-term demand. If paper silver reaches any of those levels while physical premiums are simultaneously expanding, that combination, paper at institutional support, physical supply tightening, is one of the highest probability setups in commodity markets. Now contrast that experience with leveraged exposure. If you're holding silver futures contracts, leveraged ETFs, or margin-based positions, Monday is a high-risk environment regardless of your conviction about the long-term thesis. Not because the thesis is wrong, because forced moves in thin liquidity can trigger mechanical margin calls that close your position before the thesis plays out. A 10% move against a 5x leverage position wipes 50% of capital. A 20% move wipes the position entirely. And the market does not care about your thesis when it is processing a margin call. It closes the position at whatever price it can find. This is how investors end up on the wrong side of a correct trade. They are right about the direction over 12 months and wrong about the timing over 72 hours. And the 72 hours wipes them out before the 12 months can pay off. Leverage turns a volatility event into an existential event. Physical holders experience Monday as turbulence. Leveraged holders experience it as a potential wipeout. Now, step back from the immediate setup and reconnect to the larger picture, because this is where the most important clarity lives. Nothing about Monday changes the structural case for silver, not one element of it. The United States is carrying $39 trillion in official national debt. When you include unfunded liabilities, Social Security, Medicare, federal pension obligations, the real number approaches $200 trillion. That debt cannot be repaid in real terms. It has never been intended to be repaid in real terms. It can only be managed through one mechanism: currency debasement. Printing more dollars, reducing the purchasing power of the debt by reducing the purchasing power of the currency it is denominated in. M2 money supply is already at record highs and expanding again. The Federal Reserve has been quietly resuming balance sheet expansion since late 2025. And this week, Jerome Powell made a public statement suggesting that balance sheet expansion is not inherently inflationary. That is not a casual observation from the Fed chair. That is deliberate narrative preparation. That is the institution responsible for monetary policy laying the groundwork for the next round of expansion before it becomes necessary, so that when it happens, it feels like a considered policy choice rather than a panicked response to a crisis. So here is the reality of this moment in full clarity. Short term, the system is facing deflationary pressure from a rate shock, a liquidity shock, and forced asset sales. Long term, the system is structurally committed to inflationary monetary expansion because there is no other mathematical path forward on the debt. Those two realities exist simultaneously. Most investors cannot hold both at once. They pick one, they commit to it emotionally, and then they get destroyed when the other one temporarily dominates. The setup that produces the best long-term outcomes is understanding both, being prepared for Monday's mechanical selling without abandoning the long-term thesis that the selling temporarily obscures. You saw the template in 2008. Precious metals sold off sharply during the initial liquidity crisis. Physical gold fell. Silver fell harder. Every commodity fell as institutions liquidated everything liquid to cover losses in illiquid assets. And then central banks responded. And then precious metals began their most significant multi-year rally in a generation. You saw it again in March 2020. Silver dropped from $18 to $12 in 2 weeks during the COVID liquidity panic. Then the Fed announced unlimited QE. Silver went from $12 to $29 in 5 months. The crash and the rally are not separate events. They are the same event in two sequential phases. The crash is the shakeout. The rally is the repricing. And the repricing is fueled by the same monetary response that the crash makes inevitable. That is the full structure of what is in front of this market right now. Silver closed Thursday at $72.90. That price reflects none of the rate shock, none of the oil shock, and none of the liquidity signal that hit over the past 72 hours. Monday morning reprices all three simultaneously. The downside levels to watch are $64, $58, and $50. Not because those are predictions, but because those are the zones where institutional positioning changes and where paper selling meets physical demand. Watch physical premiums. Watch COMEX inventory against the 327.59 million ounce annual low. Watch the spread between paper price and dealer cost for physical metal. Those three data points will tell you in real time whether what you are watching is mechanical selling in a fundamentally intact market, or something structurally worse. And when the Federal Reserve eventually responds to broader market stress with the liquidity expansion that the debt math makes inevitable, the reversal will not be gradual. It will not be polite. It will be the kind of move that happens in weeks rather than months, that closes the gap between paper price and physical reality in a compression that punishes anyone who was not positioned before it began. I'm going to be tracking every print tonight as Globex opens, every data point through the week, and every signal that separates mechanical selling from fundamental deterioration. Because at the moment the first price hits the screen tonight, we move from setup to execution. The analysis ends. The real information begins. And that is when everything I have laid out here either confirms or it tells us something new entirely. Either way, you're now watching this the right way.